While the media tells you that markets are crashing and global trade is unraveling, what if I told you that chaos isn't a failure, but a master strategy? Not to save the system, but to reset it. Now here's the thing. A reset means there's a new system coming. Now, most people will be completely blindsided by this, but for those of us who see it coming, who understand it and position early, this could be the biggest wealth transfer opportunity in the last 50 years. I'm Mark Moss. I've built and sold multiple companies through 3 boom and bust markets. I've studied every major monetary reset in history, and in this video, I'm going to show you what's really happening behind the headlines and what comes next and what you can do to stay ahead of it. So let's go. All right, so we're talking about the next reset. Now, if your computer is not working properly, it's too slow, you can reset it. A video game, you can reset it. You're basically starting a new game, right? You're starting a new one. And so on the other side of the reset is something new, a new system. I've been talking about this quite a lot because for me, I think it's amazing that we are alive right now for when history books will be written. I talk a lot about history, so we talk about 1913, the creation of the Federal Reserve, and 1944, Bretton Woods Agreement, 1971, the Nixon shock, 1985, Plaza Accord, and now we have a new one. Now, this is all around Trump's tariffs, but really what is he using the tariffs for? I've done a bunch of videos. If you want to go deep on that, I'll link to them down in the show description down below, because I'm not going to go back through all of that. But ultimately, the end goal is not tariffs. The end goal isn't even to bring manufacturing back to the United States. It's not rebalancing trade. It's about something called the Mar-a-Lago Accords. Now, Accords being like the Plaza Accords from 1985, which was a globally coordinated event that allowed the U.S. to devalue the dollar. Okay, so Mar-a-Lago Accords, again, we'll link to the videos that I've done on all these things down below if you want to go deeper. So it's really a modern day Plaza Accord. That's really what's happening. Now, what does that mean? Let me give you the cliff notes of that. Okay. The Mar-a-Lago Accord is a blueprint, a plan to recreate the Plaza Accord that happened in 1985. It's an intervention designed to correct the U.S. trade deficit through deliberate dollar weakening. Okay? Listen to that. Deliberate dollar weakening. Why? The strong U.S. dollar continues to make American exports less competitive. How can we balance trade when exports are too competitive, too expensive, right? And poses a major obstacle to reshoring manufacturing and rebalancing trade. So again, the tariffs are a way to help get the rebalancing of trade and help to re-onshore. But the ultimate goal is then to get that through these Mar-a-Lago Accords, which allow the U.S. to devalue the currency. Mirren's blueprint, we'll come back to Mirren in a second, Mirren's blueprint for a weak dollar policy attempt to retrofit economic theory into Trump's tariff-first agenda. So the tariffs are the first thing we need to do to trigger the rest of this. We'll break that down in a minute. Underlying fundamentals point to further dollar weakness. Again, dollar weakness, dollar weakness, dollar weakness to make the exports, to make U.S. manufacturing more competitive. An additional 3 to 5%. So 3 to 5% more weakness in the US dollar. I think it's more than that. We'll come back to that. If elements of the Mar-a-Lago playbook are initiated, they already are, further downside pressure on the dollar could form. It already is. I'm going to show you just how far the dollar could go down and what that ultimately means. And we're going to map it out as some projections of price. It's going to be super fun. But back to Mirren. So he wrote this paper before Trump was elected president. This is a Hudson Bay Capital, and it's a user's guide to restructuring the global trading system. It's a great report. I recommend you go read it if you want to dig into the weeds on this. And basically, before Trump even became president, he laid out the entire process, and he coined the term Mar-a-Lago Accords. This is where it came from. And he just happens to be Trump's economic advisor today. And we just happen to be doing the steps that were laid out in this paper. So if you want to know where things are going, you just got to read this, because this is exactly what's going on. Well, if we know what's going on and what the paper says and where things are going, then what happens next? Don't you want to know? Well, stick around. Let's break that down. Okay, so first of all, we understand that history rhymes, cause and effect. If you do about the same things, you get about the same results, right? Not always exactly, but about the same. So in 1944, about 80 years ago, I talk about these 80-year financial revolution cycles. About 80 years ago, the world got together and agreed on a new monetary system. 1985, the Plaza Accord. Not the whole world, most of the big countries of the world got together and again agreed to a new global monetary system that would allow the US dollar to devalue itself. The parallel to now is sort of the same thing. US debt is unpayable. The deficits are too big. The debt to income ratios are too big, debt to GDP. It's unpayable at current rates, so we need to bring that down. Competitiveness in the United States is collapsing, so Trump wants to fix that. So this is the plan. We have to go back and run the same playbook in order to fix those things. Okay, now real quick, I don't want to rehash a bunch of old data, but just so you can understand the Plaza Accords as it's relevant to this video, we can understand that the Plaza Accord was meant to push down the US dollar. That's the key mechanism I want you to key onto. That's what it was intended to do, push down the US dollar. All parties, the countries that were in the Plaza Accord, agreed to directly intervene in currency markets. They were all going to intervene in their own currency markets to allow this to happen, to correct current account imbalances, trade imbalances. Sound familiar? Leading up to the Plaza Accord, the US dollar had appreciated by 47.9%. So the US dollar was getting way too strong, and it was like a wrecking ball throughout the rest of the world. That put pressure on the US manufacturing industry because it made imported goods relatively cheaper. So it was so cheap to import, but it was way too expensive to export. Trade imbalances were off. The dollar was too strong. Let's get together. Let's weaken the dollar. Do you understand the mechanism that we're talking about here? Fast fact, after the Plaza Accord happened, the dollar depreciated, went down by as much as 25.69% in 2 years that followed. 25%. Remember that number, because we're going to come back and project out where maybe asset prices could go. Okay, it went down 25%. All right, now before I tell you why the dollar being so strong is such a problem and it's wrecking the economy, talking about history and rhyming, we know that about every 50 years for the last 300, about every 50 years we have this technological wave called the quantum wave. And it gives us a once-in-a-generation buying opportunity for assets if you know exactly what to buy. I'm going to break that whole process down, the quantum wave 50-year cycle, how it's a repeatable 4-step process, and how it shows us exactly what assets to buy through each step. It's about 100 charts. We'll go through it all live. We're going to hang out. We'll do live Q&A so you can understand exactly how to apply what we're teaching to your own portfolio so you can take advantage of what's coming. It's all free. There's a link down below. Come hang out with me. But let's talk about now why the US dollar getting strong is wrecking the whole economy. So really what we're seeing, just like Plaza Accord, just like the other interventions, is a strong dollar crisis. The US dollar got its guns out. It's way too strong. It's overvalued, which again, same thing as before, makes it too cheap and easy to import and too hard and expensive to export. The US dollar is overvalued. Now, what we can see if we look at the Dixie, the dollar index, where it measures the US dollar against a basket of other currencies, we're right around here, around 100. Now, that's right here. And it's nowhere near as high as we were in 1985 at the Plaza Accord. So a lot of people are like, no, there's no way that this is going to happen. The dollar's not as strong as it was during the Plaza Accords. I think that's taking the wrong view. I'm going to show you another chart. But let's just say that maybe this might be sort of more, or maybe 90. Maybe 90 is like a historic range that we're in. Maybe 88, 80, 90. That might be a more historic range. So maybe we're a little overheated, assuming that you take out this outlier. So that would bring us down from 100 down to 90, a 10% drop. Maybe down to 85, a 15% drop. Okay, remember those numbers. We're going to come back to that. But the reason why that chart is a little bit off is because it doesn't take into account other things like purchasing power parity, other things like that. So here's a chart from the BIS, the Bureau of International Settlements. And this is the US dollar real effective, the real effective exchange rate. So this is like inflation adjusted. And when we look at it like this, what we can see going back to 1966, here's 1985 Plaza Accords, we're all the way back up here. Now we're not at the peak, of the Plaza Accords, but we're pretty dang high. All right, this is the adjusted dollar amount per the BIS. So again, this dotted line right here is more of the mean. And what happens is when you go too far below, you snap back above. When you go too high, you snap back even further. And so we're due for a correction to the mean somewhere around here, somewhere from 110 to 95. 20%, sort of like the Plaza Accord saw, 25%. So we're due for some sort of a snap back to here. This is what Trump wants to do. I've given you all the reasons why that is. A mean reversion, just getting us back to the mean, the historical standard. Now, typically, a mean reversion would actually go too far, but just getting back to that historical standard is about a 20 to 30% drop. Okay, so now we understand that. We understand the setup. We understand the data. But do we understand the mechanism? So the dollar versus global M2, the global monetary supply. We have to understand there's an inverse correlation. When the dollar gets weaker, the monetary system expands. That's why asset prices go up. When the dollar gets stronger, currency goes down, asset prices go down. Dollar down equals global money supply up. De-dollarization, as nations are getting away from the dollar, putting more into gold, for example, that only accelerates this process. Now, the problem for some people who are not paying attention to this, it's a problem because inflation risks start taking off. The dollar gets weaker, the money supply expands, asset prices start going higher, and inflation starts rising. So people who aren't prepared, they get wiped out. The poor get poor, unfortunately. But so do asset prices. So for those of us that are investors and we understand this, we can make way more money than we're losing to inflation. That's our opportunity if we catch this. This is the tide that lifts some boats. Not all boats are going to go up. Which boats are going to go up? Some go up faster than others. Let's model that out. Okay, so when we think about asset prices are rising, so as liquidity rises, as the water rushes in, so to speak, the liquidity comes in, asset prices go up like boats. However, they don't all move at the same speed. So a smaller, lighter boat is going to move faster than a big, heavy boat, for example. And so we understand already, I broke down, there's an inverse correlation to the dollar. The dollar gets weaker, asset prices are going to go up. But as I said, some assets are more sensitive to the liquidity coming in. Some boats move faster. Here's a chart that sort of breaks this down for us. So here we go, a chart from Bitwise here. The green lines here are since 2010. We have the dark gray line since 2017, and this blue line is since 2020. They're all about the same. We have Bitcoin right here, and you can see it's moved up the fastest. It's the fastest boat. Now you can see since 2020, it's been a faster rising boat. It's more sensitive to liquidity than it was in 2017 or it was in 2010. But in all these areas, it was much faster, a much faster boat than the S&P 500, a much faster boat than the MSCI, just a big basket, and even much faster than gold. So these are all the different assets, S&P 500, gold, Bitcoin, and this shows the sensitivities or how fast they move as liquidity rushes in. So if you want to run from a rushing tide, a tsunami is coming on shore, you want to get into the fastest boat possible, and Bitcoin shows us that. Now we can also see, as I said, like this is inversely correlated. So here's a chart of the dollar index and the global monetary supply, inverted. So what we can see is the global monetary supply is inversely correlated with the changes in the dollar. So what we can see here, the green is the dollar index and the black line is the global money supply. So when the dollar index goes down, this goes up, right? When this goes down, this goes up. So we can overlay the charts to understand where these are coming. So let me show you what this looks like. All right. So we can see when we overlay now the global money supply with asset prices. So this is the global money supply in green with the Bitcoin price in black. And it's adjusted for a 3-month lag. If you watch my videos regularly, you understand I talk about global liquidity all the time and how there's about a 3-month lag. I'll put a link to a video down below that sort of breaks that down in more detail. Now, what we can see adjusted for a 3-month lag is that these move almost in lockstep. What we can see is that here the global money supply has taken off. Bitcoin is just trying to start catching up, but it hasn't all the way. So looking at these charts, where do you think it goes next? Well, I think it seems pretty obvious. Now, another factor is that what we can see when we map out the global money supply moves, the dollar index strength, compared to an asset that's very sensitive to liquidity like Bitcoin, what we can see is a chart like this, that when Bitcoin moves in its, let's break it down to 80-20, when it's the top 20% strongest move in the dollar index or the bottom 20 move on the dollar index, Bitcoin has its strongest moves. And so if the US dollar gets very, very weak very quickly, Bitcoin moves even faster. If the US dollar gets very strong very quickly, then Bitcoin draws down even faster. But what's the policy of the Mar-a-Lago Accords? To weaken it. How much? Well, it should revert to the mean, which could be 20 or 30%. How much did it happen last time? 25%. That's an extremely fast move, which means we might expect Bitcoin to move extremely fast in the other direction, if that makes sense. Okay, now let's try to model that out a little bit, now that we've sort of built that house of cards, if we model the move. So if the US dollar is overvalued by 20 to 30%. And again, this is a chart from the BIS, the Bank of International Settlements. They're the central bank of all central banks. So if it could revert to the mean right here, again, it'll probably snap past and come back. But if it just comes back to the mean, we're looking at a 20 to 30% drop. It went down 25% in the coordinated fashion after the Mar-a-Lago Accords. Maybe it goes down 10 or 15%, we don't know. But what we do know from mapping these things out is that for every 10-point drop in the dollar index, we get a 2 to 4x in Bitcoin. There's a range. Typically, Bitcoin would move 2 to 4 times for every 10% drop. Okay, so if we put this math together, Bitcoin's sitting at about 100,000 right now. 93, 95, 97, somewhere in that range. Call it 100,000. And let's say we get a 20% decline in the dollar index. Then we multiply that times a 4 or 8 times move. Well, why 4 or 8? Because we get 2 to 4 for every 10. So 10 would be 20, so a 4 or 8 times move. So that would mean, I'm not real good at math, that's why I use general numbers, 100,000 times 4 equals 400K. 100,000 times 8 equals 800,000 K. So if we see liquidity, the dollar index devalued by 20%, like has been history, like would be the reversion to the mean, this could be a potential catalyst that we could see Bitcoin move up to this level. Then we can add in other things on top of that. For example, massive ETF flows coming into Bitcoin. Halving cycles come into play. Sovereign adoption, like the United States Strategic Bitcoin Reserve. Other nations doing their own Bitcoin Reserve. So then we start to add other things that even compound onto this, and you all of a sudden start to realize which one is the fastest boat. Now, this is, again, another chart here from the BIS, again, the Bank of International Settlements. And what they're doing here is predicting the US dollar performance over the next 5 years. Do you see this line going down? This is what the BIS is planning for. This is what the policy of the Trump administration is. And this is most likely where the world is going. Okay, so where are we at? We understand that we're going through a monetary reset. It's not that uncommon. This is what presidents do. Several presidents have done this in the past. 1913, 1944, 1971, 1985. And here we are, 2025. That's happening again. We're living through history of monetary reset. The reset happens and we get something new. There's one thing they have in common. There's a new system. Those of you who don't see that new system and move, then you get left behind. Those who do see the changes and move to get in front of that, to front run that, benefit the most. It's not a crash. It's a transition into a new system. Now, the tariffs that we see all over the news are leverage. It's not about goods, it's not about manufacturing. It's leverage to devalue the dollar for the entire monetary system. The Mar-a-Lago Accords that you hear about ultimately is about bringing the dollar down, just like we saw in the Paris Accords. And that's not a bug. People think the dollar's strength has to be its feature. It's not. Bringing it down is not a bug. It's the plan. It is the feature to bring the dollar down through these negotiations. And in that, we understand that as the dollar goes down, global liquidity goes up. We want to move into assets, and different assets float at different rates, and Bitcoin moves the fastest. It's not just a hedge anymore. It is what we call the global life raft. Now, we also understand that in context of these 50-year quantum wave cycles, and this would also tell us that the only place to invest right now is right here, which is the convergence of Bitcoin and AI. Of course, it's no wonder that's where all the money is going. That's why I study these cycles in great detail. There's 4 distinct phases that you want to invest through in this cycle. If you want to see me break all that down so you can understand what the blueprint is, so you can invest along, come hang out with me live. Next week, we'll break it all down. I'll go through all the charts, all the graphs. We'll do a live Q&A so you can understand how to apply it to your own portfolio. But if you really want to understand more about the Mar-a-Lago Accords and where those are going, you probably want to watch this whole video right here where I break it down in more detail. And I hope to see you over there.